Candlestick patterns are a fundamental tool for traders, offering valuable insights into market sentiment and price movements. By analyzing the shapes and sequences of candlesticks, traders can identify potential reversals, continuations, and optimal points for entering or exiting trades. These patterns serve as visual cues that reflect the ongoing battle between buyers and sellers. Understanding candlestick formations helps traders anticipate market direction, making them an essential component of technical analysis. Mastery of these patterns can significantly enhance decision-making and improve trading outcomes. The doji pattern is a unique candlestick formation that occurs when the opening and closing prices of an asset are nearly identical. This results in a candle with a very small or non-existent body, often accompanied by longer wicks. The doji pattern is significant because it reflects a moment of indecision in the market, where neither buyers nor sellers have gained control. Traders often interpret the appearance of a doji as a potential signal for a reversal in the current trend, especially when it appears after a strong upward or downward movement. However, confirmation from subsequent price action is typically needed before acting on this signal. The hammer pattern is a candlestick formation commonly observed in technical analysis. It is characterized by a small body and a long lower shadow, indicating that sellers pushed prices lower during the session, but buyers managed to drive the price back up near the opening level. This pattern typically appears after a downtrend and is interpreted as a bullish reversal signal. Traders often look for confirmation from subsequent price action before acting on a hammer pattern, as it suggests a potential shift in market sentiment from bearish to bullish. The shooting star pattern is a candlestick formation that typically appears after an established uptrend in the market. It is characterized by a small real body near the lower end of the candle and a long upper shadow, indicating that buyers pushed prices higher, but sellers quickly regained control. This pattern signals a potential shift in momentum, serving as a warning of a bearish reversal. Traders often interpret the shooting star as an early indication that the upward trend may be losing strength, prompting them to reassess their positions. Recognizing this pattern can help investors anticipate possible declines and adjust their strategies accordingly. The bullish engulfing pattern is a candlestick formation that often signals a potential reversal in a downtrend. It consists of a small bearish candle followed by a larger bullish candle, which completely engulfs the previous candle's body. This structure indicates a shift in momentum as buyers overpower sellers during the second period. Traders interpret this pattern as a buy signal because it suggests increasing demand and the possibility of upward price movement. Its reliability is heightened when it appears after a sustained decline, reinforcing the likelihood of a trend change. The bearish engulfing pattern is a candlestick formation that often signals a shift in market sentiment. It occurs when a larger red candle completely engulfs the previous smaller green candle, indicating that sellers have taken control. This pattern suggests increasing downward momentum as buyers are overwhelmed by selling pressure. Traders commonly use the bearish engulfing pattern to identify potential short opportunities, anticipating further declines in price. Recognizing this pattern can help in making informed decisions about entering or exiting positions in a market downturn. The morning star pattern is a widely recognized candlestick formation in technical analysis, signaling a potential bullish reversal in the market. It consists of three distinct candles: a long bearish candle, followed by a smaller-bodied candle that can be either bullish or bearish, and finally, a strong bullish candle. This sequence reflects a shift in momentum where selling pressure weakens and buyers begin to take control. The morning star is considered a reliable indicator, often appearing at the end of a downtrend to suggest that a new upward movement may be underway. The evening star pattern is a well-known candlestick formation in technical analysis, often signaling a potential bearish reversal in the market. It typically appears after an uptrend, suggesting that buyer momentum is beginning to weaken. The pattern consists of three candles: a strong bullish candle, a small-bodied candle indicating indecision, and a final bearish candle that closes below the midpoint of the first. This sequence reflects a shift in sentiment as sellers start to gain control. Traders use the evening star to anticipate a possible downturn and adjust their strategies accordingly. The piercing line pattern is a bullish candlestick formation observed in technical analysis. It consists of two candles. The first is a long bearish candle, followed by a bullish candle that opens below the previous close and closes above the midpoint of the first candle. This pattern signals a potential reversal, indicating that buyers are beginning to regain control after a period of selling pressure. The appearance of the piercing line suggests renewed optimism among market participants, often leading to higher prices as demand increases. The hanging man pattern is a candlestick formation that typically appears after an uptrend in the market. It is characterized by a small, real body near the top of the trading range and a long lower shadow, suggesting that sellers pushed prices down during the session, but buyers managed to recover some ground. Despite this recovery, the presence of the hanging man signals potential weakness, as it indicates increased selling pressure. Traders often view this pattern as an early warning that the prevailing uptrend may be losing momentum and that a reversal or pullback could be imminent. The three white soldiers pattern is a notable bullish reversal signal in technical analysis. It consists of three consecutive strong bullish candles, each opening within the previous candle's body and closing near its high. This formation indicates sustained buying pressure and often marks the end of a downtrend. The pattern structure provides traders with a clear visual confirmation that momentum has shifted, suggesting a potential trend reversal. Recognizing this pattern can help investors anticipate upward movement in the market. In summary, while candlestick patterns can provide valuable insights into market trends, their effectiveness is greatly enhanced when used alongside other trading tools and indicators. Relying solely on candlestick signals may lead to incomplete analysis and missed opportunities. Integrating technical analysis, volume data, and fundamental research helps build a more comprehensive trading strategy. Equally important is practicing sound risk management, which protects against unexpected market movements and preserves capital. By combining these approaches, traders can make more informed decisions and improve their chances of long-term success.